Hello, Lance Ippolito here, and I want to go over some option spreads in today's market. So what I have here is a chart of Facebook, and if I look at Facebook really for the past 2 months or so, not a lot of price action has occurred. If I really break it down, for the past, really since early May, we've been up, down, up, down, up, and down. So if you're trading directional options, let's say calls or puts. If I'm buying calls, I want to buy calls here, sell them up here, or buy calls here, sell them up here. Or if I'm buying puts, I want to buy puts up here, sell them here, buy puts here, sell them here. But that could be very difficult because if you look at things, there's been very minimal price action, especially for a 155 or $150 stock like Facebook. $2 to $3 in a direction is really nothing. So how can a trader still make money when the stock or the market, whatever you're looking at, is flat or directionless? There's really no confidence to the upside or to the downside. And even if you ask me where Facebook is going, I would probably just say sideways. So what can I do to take advantage of the price action of going sideways? Well, there's a couple things. First, you could always put on any of your chart, you could look at a volatility graph actually on Thinkorswim. It's IMP volatility. So I'll just go to apply and you go to the daily chart, and I can see, because the first thing with option spreads especially is understanding volatility if you're selling and buying options. So if you look at the prior history, this is volatility down below here in Facebook. You actually see Facebook volatility is actually elevated. That could be for a number of reasons. Usually it's an earnings event, but since the market here and the NASDAQ is off the highs a lot, volatility increases as a stock or an index goes down. When a stock usually goes up without an earnings event, you'll actually have volatility die down. Like if you look here, for example, we have the earnings event right here, and on each earnings event, you notice that volatility is high because there's demand for the options. So option prices will be expensive. After the earnings event, volatility goes lower because there's less demand for the options. If you're getting directional, if you're buying protection, the uncertainty of the earnings event causes volatility to rise. You see here, even as the stock goes up, volatility goes lower and lower. So if you're buying options, the options are going to go down in value because of volatility, even though the stock is going up. So it could be very difficult to do. If you look at this last earnings event, stock really didn't move, but volatility went lower. So that's at first good to understand. So right now, I would say Facebook volatility is relatively high. Nothing crazy because they don't have earnings, let's say, upcoming next week, but it is a little bit elevated than normal. So let's remove it. So the next thing I need to do is go to the option chain. I need to first say, what is my opinion on Facebook? Again, sideways. So what can I do to take advantage of the sideways price action? So I could look here at Facebook, the options. I could look from weeklies to monthlies to further out, and you could see the number of days till expiration here. Now what you'll have, and this is always important to look at, is to find when does the earnings event take place. So you could Google or use your favorite website to see when Facebook has earnings. But I can find, just looking right here, this is the volatility and the implied move. I can find this just by going to the option expiration with the highest volatility. So you see how it goes from 22%, 22 to 23%, and then it jumps right here in July 28th to 30% with a $9 implied move. This, I'm assuming, is the earnings event week, so July 28th expiration. So maybe they report on the 25th, but I would say that this option expiration, the 28th, captures the earnings event because of volatility going higher. And the market makers are thinking Facebook will move $9 between now and July 28th expiration. And if you look at the option prices, the calls and the puts at the money, see how they're about $4 and change compared to the prior week, which is only about $2 and change. So I know if I'm trading this week expiration, option prices will be high because of the earnings event. So normally, I'll trade the earnings event the day before earnings because that's all I want. Let's say Facebook goes down another $5 from here. I don't want to obviously trade the earnings expiration because then I have the $5 move lower, then I have earnings to worry about. So what I like to do is go to an option expiration that doesn't have the earnings if I don't want to play the event. So I can look here at July. Here in July, see how the implied move rises as further out in time the option expiration is. So I can look here in July and say, what is the implied move for July monthly expiration? About $5.70. So Facebook, if I look at 149, let's say it moves $5.70, I can look to about 156 and change. And to the downside, I can look to about 143-ish or so. So that I have, and I can look at the 143 puts are going for about 75 cents. I could look to the upside, let's say the 157.5 calls for about 35 cents. The problem with buying the outright, especially out the money calls, is let's say I buy these 157.5 calls for 34 cents. Let's go back to the chart. I need Facebook to trade 157.5 plus the 34 cents by July expiration, and let's say it just continues, let's say it goes up slowly. Since they're so far out of the money calls, I'm still basically going to lose money. I need a quick move to 157.5, which I don't think will happen. So what can I do? What I can do is look at an option spread on Facebook. I can look to sell premium, we call it. Selling premium is usually, depending on your strikes, a neutral strategy. So what I would like to do here on Facebook is sell a bull put credit spread. And what I can do if I just sell let's say the 147 puts outright, I collect $1.71. But here's the problem with this. Let's analyze it. I collect my $1.71 as long as Facebook is above 147. And you take the 147 minus 171 to get your break even, which is about 145.31 or so. Problem is, what if Facebook goes lower, let's say to 140? Then I lose possibly $500, if not more, if it continues to go down and down and down. So if I look at the chart and say, hey, 147 is not that far away. If it starts trading lower, let's say it takes out 144, I'm in big trouble on that trade. So I don't want to do, we call it selling a naked option. Let's say it goes down to 140, 144, I start to lose money. So ideally, and the margin requirements are going to be crazy because let's say we have a crash, then I'm really losing money. So what I can do is sell these 147 puts, but also buy the 146 puts to make it a bull put credit spread. So I could collect 30 cents on this trade. So let's analyze this. Let's get rid of that one contract. There we go. So this trade looks like this. Let's say let's go back to one contract. This trade looks like this. As long as Facebook is above 147 puts that I sold, right here, I collect my $30. Let's say Facebook trades below 146, then I'm on the hook and my max loss is limited to $70. What is my break even? It is 146.70. So I take 147 minus the 30 cents I have, and you can see my break even here is 146.70. So I can make money on this trade, and let's go back to the chart one more time. as long as Facebook stays above 147 by July monthly expiration. So it can stay sideways, it could go down actually a couple dollars. Let's say it goes up, well then that credit spread is just going to continue to go down in value, and maybe I could buy it back for 10 cents. So let's analyze it one more time. And we see here the probability of this trade making money. Right here is 61%. So I have a high probability of this trade making money. And I have about a 38.5% chance of losing money on this trade. So the probability is in my favor. Usually if I have a 60% chance of probability, I usually want to get around 35 to 40 cents of a credit. But I know my max loss is limited to $70. So let's say I wake up tomorrow and Facebook's trading at 140. Well, boom, I'm done. I lost 70 bucks pretty much, unless it starts to trade up. Let's say tomorrow I wake up and Facebook's at 150. This bull put credit spread that I sold for 30 cents is probably going to be worth maybe a nickel. So I could buy it back for a nickel or so and make my $25 per contract. So very high probability trade. And let's say every day that goes by, what's good is every day that goes by, that time decay that you have with buying options is actually in my favor. So let's say every day Facebook continues to trade around 149 and it doesn't do anything. Every day I start to make money because the prices of these puts will continue to go down in value. So since I sold them, I want to buy them back for a cheaper price. And I can do the same thing. Let's say I'm bearish on Facebook. Let's say I don't think Facebook will get above 150. We'll say 150 by July expiration. I can do the same thing. I can sell the 155 call spread and collect $1.68 per contract. The only problem with this, it's a $5 wide spread, which I usually don't like. I like dollar wide spreads. But I can do the same thing as long as Facebook is below 150 by July expiration. I have, again, time on my favor, and I don't have to get too directional. So let's look at an example of a debit spread, like a call spread, for example. So let's say I am very bullish on Facebook now. Let's say the market starts to pop tomorrow, and I say, you know what? Actually, let's do a new stock. Let's do Apple, because Apple has dollar wide strikes. Let's say I think Apple is going to trade at 150 by July expiration. I just woke up and market's up, and I'm very bullish now. So I think Apple trades at 150 by July expiration. And let's look at a call spread. So instead of buying these 150 call options that are going for 24 cents, that have a low probability of working, I can actually analyze to see how low a probability it is. Literally only about a 15% chance. And so about a 15% chance of that trade actually working. I don't want to buy the outright calls. So let's say Apple continues to trade sideways, then these calls go down in value. The market makers are only implying almost $5 by July expiration. So if I add $5 to 143, it gives me about 148. So what I can do is buy a call spread to take advantage of, let's say I think Apple goes up $5. Maybe I think it goes up more to 150, like I said, but I want to limit my capital requirements and not buy outright calls directional. So what I can do is buy the 145 calls, so they're going for about $1.30, and sell the, let's say, 149 calls for about 33 cents. So actually, let's There we go. If you click Control and hold it down, you can actually do a spread on Thinkorswim. So I want to buy the 145 calls, sell the 149 calls for about 33 cents. And now let's even it up to full dollar. I'm paying $1 debit for this trade. So let's go to one contract again. So now I'm risking $1 or $100 per contract to potentially make, since the $4 wide spread, $300 on Apple. And what I like about this is my max loss is limited to $100 per contract. So the $1 debit. My max gain is also limited if Apple trades above 149. But my whole intention on this trade was I thought Apple would possibly trade up to 150. So I actually have about a 35% chance of the trade being profitable, and I'm getting about a 3-to-1 risk versus reward on my trade. So that's why I like using call spreads. I can limit my risk to the downside, but also my risk is limited to the upside, but I had no intention of thinking Apple would trade above. Really, I'm limiting to 149. I could do the 150 calls. I could sell those if I wanted to, but I didn't think Apple was going to trade much higher than 150. So I limit my reward up here. I limit my loss here. And this is an example of a call debit spread.